Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello and welcome to the Retiring Real Estate Investor Podcast. I am your host, Brandon Bruckman. I am joined by Dan Lewkowicz. He is a top commercial real estate broker, creator of the CRE Pro Course, and the host of Dan on Top of All Things Commercial Real Estate. Dan, you don't have anything going on, do you?
Not much, man. Just hanging out, relaxing.
Not at all. The schedule seems busy with everything you have going on. Maybe start us off with a bit of your background for our listeners. Tell us where you're from, how you got to where you are. Give us the background for our listeners.
Yeah, absolutely. Thank you. And thank you for having me on. I definitely really appreciate it. So I'm Dan Lewkowicz. I am here locally in the Metro Detroit area. I'm the Senior Director of Encore Real Estate Investment Services. We are, I hesitate to use the word boutique, but I like to call us a boutique net lease investment sales firm. And the reason I hesitate is that we're pretty large. Last year alone, we sold $985 million of net lease real estate. We've got 37 agents, 3 offices, and this is really all we do is net lease. So I love net lease. I love commercial real estate and everything real estate to begin with. I got my start in real estate about 20 years ago, almost 20 years ago, helping to build a company that did barrier-free home modification for people that had terminal illness or injury. And I later started flipping homes in and around the city of Detroit. Spent some time as a director of a sales department at a title insurance agency and as a business development executive at Amazon, and eventually found my way to commercial real estate brokerage, which is where I've landed and stuck for a long time. I specialize in all different types of net lease. I would say that my favorites are probably quick service restaurant. So your Taco Bells, your Wendy's, your Chick-fil-A's, Chipotle's, etc. Well, Chipotle's may be more a fast casual brand. We do a lot of pharmacies. So I have a CVS listed right now. Just sold another CVS and a Walgreens recently. A lot of medical office buildings. One of my specialties and my favorites are shopping centers. So multi-tenant retail shopping centers, typically from 10,000 to roughly 180,000 square feet. We do everything for our clients in terms of advisory services. Our main goal is to maximize the value of the assets in their portfolio. I have 5 kids. And I enjoy yoga, running, lifting weights, exercising, going to the beach, all that good stuff.
That's outstanding. Thank you for the background. I want to hit on net lease right away. Can you give us sort of the playing field has shifted for us in real estate, to say the least, with rates going up and then inflation. Can you talk about some of the impacts on that on the net lease environment that you're seeing?
Yeah, definitely great question, and one that I get asked on a regular basis. So inflation in general, while it may not be a good thing, specifically for real estate, it is a good thing. Inflation typically makes the values of tangible assets like real estate, hard assets, skyrocket. Now we're living in a very odd time with incredible inflation and incredible reactionary movements by the Fed to, in their words, get inflation back to a 2% benchmark where it typically is. As a sidebar, the easiest way to get it back to that benchmark is to change the benchmark, which is definitely something that the Bureau of Labor Statistics and the Fed have done over the years, and they're doing right now. But that's probably an aside for another time. In terms of the effect of the rapid rise of interest rates on net lease specific, it's been impactful. I mean, we've definitely seen a pause in the market. Transactional volume is down. Quality real estate, trophy real estate is still selling. Assets that are priced right are selling. I mean, the market is still moving. It's still robust and healthy. It's just that the transactional volume is definitely down. We are seeing what I call a dislocation between buyers and sellers right now, which is, I'm sure, the case in most, all asset classes in commercial real estate, where sellers are still stuck on pricing from a year and a half ago, and buyers are, thinking that everything is the floor is falling out, and they're looking at pricing from 2 years in the future. So that disconnect is difficult, and that's my job as a broker to bridge that gap. I think that will lessen once we see the Federal Reserve keep interest rates stable for a continued period of time, which I still personally believe that we are far away from. So as a broker right now, I'm advising all of my clients and anyone listening to have their properties evaluated so that they know what the properties are worth, because valuations from 6 months or a year ago are relatively worthless since values have changed so much. And to keep in mind that, in many cases in a market like this where things are transitioning, those who act quickly and prudently are the ones that are best off. So today, it may be best for an investor, obviously every situation is different, to sell a building today versus holding on to it for a few years and letting values fall even more. I don't personally foresee interest rates going back to that 3% threshold. Maybe not ever, probably not in our lifetime. So I think that we're going to have to get used to an interest rate environment that is similar to where we're at today.
No, that's very interesting. Do you think the disconnect there between sellers and buyers is more on the seller side and their expectations that have been built up over the past 6, 8, 12 months? Or is it the buyers reaching a little bit and saying, hey, look, things have changed and I expect a discount here? Are they asking for too much? Where do you think the big separation is there? Or is it both?
Yeah, candidly, I personally believe it's more on the sell side. I think that it's psychologically very difficult to lose something, right? So if I have an item, right, that is worth $100, for example, and then it goes down to $80, my aversion to selling it at 80 is very strong. I might hold on to it when it goes down to 70 to 60 to 50 to 40 because I'm remembering the days of being worth 100. Keep in mind, these sellers have been, exposed to incredible prices. I mean, the prices of 2020 and 2021 were historic. So it's very difficult to come back down to reality after being, at a historically high price time. I think that buyers always overreach in general, so nothing new here. But I think that sellers are having a hard time coming to terms with the new pricing paradigm. And again, I hear it every day. Dan, I'm going to give it a year or two when interest rates will go back to where they were. And I just don't see that happening.
Yeah, we sort of equate, and this is so psychological, not economical, because when we sort of look at the economics, if I had to guess, most sellers have held these properties for a significant amount of time. They're staring at probably a significant gain, even in these times, and a pretty good return on investment. But man, the psychology is really tripping you up. We relate this a lot to when we came out of 08, 09 from a public markets perspective. We watched investors, unfortunately, sit on the sidelines for another decade. And that was painful as they watched the markets run up from bottoms. Yikes, right? And so it's kind of painful. The psychology here is definitely a huge factor. We spent a ton of time talking about. Is it fair for me to characterize, folks, like when you look at this from an economic perspective, there's still probably most sellers are probably still staying on a pretty significant gain here, correct?
Yes. In general, if you're looking at somebody that bought over the last 20 years, yeah. But the challenge is, what about the guys that bought in 18, 19, 20, 21? Those people are standing in a situation where they have negative equity, right? Mm-hmm. And even more importantly, perhaps many of those individuals bought, if you look at the 30-year fixed or the 10-year treasury going back to 2019, it was really low. We were talking like around 2%. I mean, in some cases it was at close to zero. So their borrowing costs were 3.5%. So the real I think tidal wave that's going to hit our industry and really all aspects of commercial real estate is when those loans come due, which is in the next couple of years. When those loans come due, sellers are going to be faced with, or owners are going to be faced with a pretty sobering reality of having to either, bring cash to closing, right? Or have
Mm-hmm.
negative leverage if they refinance or sell.
Mm-hmm.
So I think that that's going to be a big, big shot in the arm to the market. And that's coming, sooner than people think.
Yikes. So yeah, problematic. If I kind of refer to it as I've been saying to a lot of folks, just with the move in interest rates, some folks have just been caught off sides. And there's kind of you can't really go back. Like the Fed threw the flag. I'm gonna carry this football analogy out. The Fed flew through the flag, and there's no way to put it back. This is where we are, and I think you are right. Rates remain in this environment, so when these refis come, you're off sides, and there's not much you could do about it in those aspects. What do you? And I think that's probably where your advice is coming from, where you're asking folks, hey, maybe you should consider about selling here at a price that may not be as favorable as you thought it would be 6 to 8 months ago.
Yeah. So, I mean, my perspective is like, you want a little bit of pain now or a lot of pain later, And I think that there's still opportunity. Like to your point a few minutes ago, Brandon, is that the market is still very, very, it's not only strong, but the prices are still very high, relative to the last 15 years. So, sell now and enjoy that and relish in the fact that you're selling, pretty close to the top. It's like you could look at this the other way around. If I didn't buy at the bottom, right, but I bought a little bit after the bottom, wouldn't I still be happy, right?
Mm-hmm.
So this is the same thing. If I didn't sell at the top, but I sold close to the top, isn't that still a win? I think that we oftentimes have to, keep things in perspective and understand that it's okay to take a small win or a medium-sized win or a large win, even if it's not a windfall, it's still a win.
Mm-hmm. Exactly. Or maybe in some cases, a small loss would be a lot better than the tragic stories on our end are large losses that we're constantly trying to avoid. Those are the ones that set you back in a big way. And so we're trying to avoid those wherever we can. So yes, to everything you said, I would even advise a little loss isn't that bad. We can recover from that. But big losses, oh boy, we've dug ourselves a pretty big hole that we don't really want to dig ourselves out of. So hear you on that. So that's an interesting state of affairs. Yep. Is there anything different between, you mentioned in your intro, some of the different areas of triple net. Is there any characteristics of those that are really interesting when you talk about maybe the multiple tenant strip mall versus some of the food or fast food type assets? You seen anything interesting in either of those that's different?
Yeah, I mean, each of those asset classes presents some unique characteristics. If you want to dial in on shopping centers, which is one of my specialties,
yes,
you have a lot of opportunity there because many of these shopping centers have below market rents, and many of them have tenants that maybe aren't the best for the center and could be changed, could be replaced. But what's really important for people to recognize is that in the net lease arena, if you have an opportunity to increase your NOI, your net operating income, you have to do it, and it's so impactful. So, for example, $100,000 increase in NOI, which is a large increase, but $100,000 increase nonetheless, at an 8% cap is $1.25 million of value added to your property, right? So you can literally take that asset and make some changes, change the cash flow, make it better, and then also build up equity. So I think that's a huge opportunity in multi-tenant. On a kind of an unrelated note as it pertains to a quick service restaurant, what I really like about that asset is that it's relatively easy compared to maybe some other types of investments to understand how strong the property is. So the property in general, obviously every property has traffic counts, how many vehicles go in front of the property, and demographics, how many people are living within a 1, 3, 5, and 10 mile radius. And, average household incomes, average home values, all those things. How, is it at a hard corner? How close is it to a freeway? Those are all going to be characteristics to evaluate and underwrite when you're looking at commercial property. With fast food in general, in many cases, you can actually get access to the tenant's financials. It's important if you're drawing up a new lease with a tenant to ask in the lease to make sure that you have a clause that they have to report financials to you. So you can actually see in many cases the sales that the tenant is doing. And amongst all forms of real estate and tenancy, quick service restaurant has the lowest cost of occupancy. So the cost of occupancy on average nationwide for a fast food restaurant is just under 6%. Okay. When I'm evaluating a quick service restaurant, I want to make sure that and cost of occupancy, by the way, is going to be your rent, okay, that you're paying, that the tenant is paying, divided by the sales. So I want to see that ratio under 8% at the most. But that gives me an idea of like how likely is it that this operator is going to be successful in this location. So that's a little nuance that I like, because it gives me a little bit of an added insight into not only how well is the real estate positioned, but how well is the tenant performing.
Oh, that's the gold nuggets are here. Okay, so this is the part that you brought up that we've struggled with personally as a firm in evaluating triple net deals is we don't always get the tenant financials, and that's been a big hang up for us. So you mentioned in the fast serve you usually have access to that. What about in some of the multi-tenant? And I usually see it as a problem in the multi-tenant where there's always 2 or 3 of those tenants where I don't really have solid financials on. Can you talk about mitigating some of that risk in that multi-tenant asset?
Yeah, I mean, you to mitigate that risk, you have to kind of go back in time when that previous owner, who maybe wasn't so savvy, was signing that lease. So really, the only way to mitigate it is to amend the lease or to change the lease or to get a new lease. So what I always tell people is, let's say you're making a change to the lease. Let's say tenant comes to you, they want a rent reduction. It's just as an example. Okay, fine, we agree on a rent reduction. Well, don't agree on a rent reduction and get nothing in return. Agree on a rent reduction and put a clause in the lease or in the amendment that says that the tenant has to provide financials to you. So really the only way to mitigate it, Brandon, is to make sure that either when the lease is signed, it's in there, or as you go along, you do some negotiating with the tenant to get the financials in there. I'll tell you that in multi-tenant retail, shopping centers, very uncommon to have tenant financials available. So when I'm underwriting them, I like to look at, in most centers, not every tenant is going to be a national or even a regional tenant, but I always like to see some, larger tenants. But, to me, the more important thing is, how is the tenant doing, as a company, nationwide? If I can get some financials, I that's good too. What I will say is that another way to mitigate it, I'm thinking as we're talking, is just to have a candid conversation with the manager. I mean, when I list a property, I almost always try to get in touch with the manager of the property to get an understanding firsthand. How is this, this location doing? Now, the manager may tell you, I'm only allowed to give that information to the district manager, which is common. But every now and then you'll get someone who will give you the information or will tell you something that can let you know how they're doing. Now, another thing, and this is just anecdotal, is to either, spend time at the site or have somebody else spend time at the site and just take a look at the parking lot, right? A healthy property is going to have a relatively full parking lot during most of the business time. If I see a parking lot that's empty, to me, that's a red flag, right? If I see a store that's empty, to me, that's a red flag. So I think that those are all important, questions to ask. And then obviously, if you're dealing with multi-tenant or really anything, but specifically multi-tenant, you want to make sure that you've got a good backfill potential. Like, is this real estate sound? Is it on a good corner? Or is there a lot of traffic? Is the household income at a relatively high level? Will I be able to backfill at current rent or higher? And if the answer is yes, then it's not as alarming.
Oh, that's really interesting. So when you think about that, could you think about some of these properties being almost, or what you'd look for in an ideal situation is almost a tenant-proof property, where those underlying demographics and metrics are so strong that if I lose, maybe you even want to lose, in some cases, a tenant that might not be performing, I can plug somebody else in that's successful. Is that a way for me to sort of think about it?
Absolutely. No, that's very well said. And in fact, that's very well said. I have a client that I sell some of my shopping centers to, and one of the first things he asks for when he's underwriting the shopping center, that's never available just at large to the public in the offering memorandum, is he wants historical occupancy, ideally over 10 or 20 years. Because it's one thing if the property, is all shiny and nice and occupied right now, right? But what if a year or two ago it was 70% vacant? And what if they couldn't fill it for forever? And what if these tenants leave? Historical occupancy is kind of like what you're talking about, where the property is tenant proof. Over the last 20 years, historically, we've had 95% occupancy every single month except 1 month. Okay, that tells me that's an attractive property. Well, it tells me a few things. Either one, the rents are priced way too low, okay, which is possible. So you want to look into that, because that should be a consideration. But more likely, that property is desirable. There are tenants that are available. That the tenants that are there long term, and when they leave, the suites are filled up very quickly. So yeah, that's very important. Now, on the other hand, if you're a value add investor, you may want a deal that wasn't managed properly. You might want a deal where in the market the rents are $14 a foot, and in your property the average rent is $9.50 a foot, because that is massive opportunity, right? And from my perspective, that might be a property that I'd want to invest in, is one where I could make some tweaks. I could bump tenants up at when their lease is up, or I could do some rollover if necessary to tenants paying market rent. Because again, when I'm adding in NOI, right, like people sometimes don't realize how powerful a low cap rate is, right? Again, $100,000 at 8% cap rate is $1.25 million in value. At a 5% cap rate, what is that? That's $2 million of value. So, don't discount the fact that the opportunity that's there can be much larger than what it looks like on the surface.
No, that's very interesting for value add. Yeah, I mean, I consider, or I would think about the opportunities from a value add perspective in terms of where can I drive revenue to? That's a reasonable expectation, and kind of measure the theoretical cap rate that way. So I have a better sense of, what capital am I deploying to get X return? What cash flow am I really buying that I can get to, not what I'm buying today? That's interesting. I'm going to kick some theses that we've been kind of kicking around internally, very selfishly, to get some answers from you on. Is it fair for us to think about, we're thinking about this concept of path of progress. And what I mean by that is there a play here for development of multi-tenant, triple net in the way of progress? So I live here in the suburbs of Milwaukee, Wisconsin. I'll give you an example. I live in a place called Pewaukee. As you keep heading west, there's more and more building and development. And I'm starting to see these smaller sized triple net multi-tenant pop up, right? Does it make sense? Is that a strategy you watch people follow, of following that path of progress and thinking about development of the next triple net multi-tenant property?
So I guess is your question, does it make sense to purchase land near these, up and coming areas and then develop? Is that what you're asking?
Yes.
I mean, without seeing the real estate and the market and all that, I can't obviously give you an answer that's like a rubber stamp. But what I can tell you is that, it amazes me, watching developments. Like, for example, when there's a Home Depot I'm thinking of near where I live that was built, I knew it was a matter of time, maybe 5 years, before they build a little in the parking lot, a little out parcel. And, lo and behold, a couple of years ago popped up, a Citizens Bank, mattress firm, and whatever it is, tropical smoothie cafe. So, if you have big tenants, big anchors that are going to draw traffic, that's going to be an opportunity to develop something. In fact, like I'm dealing with a pretty large shopping center right now in New Jersey that has a lot of out parcels like what you're describing. And, this developer just said, hey, I've got this piece of land. It's great dirt. I'm going to build the shopping center, but I'm also going to build all these out parcels. I'm not going to wait, So I think that there's definitely opportunity there. If you can get a hold of some land that's, adjacent to some major national developers, there's national brands, I should say, there's definitely going to be a need for, doing something with that traffic flow that goes through your property. So, I think that's one of the most important things to look at, is how much traffic is being drawn to that area, right? Almost all the developers, you can go on their website and find their specifications for what it takes to build, let's say a Family Dollar, or I don't know, a Wawa, or Dollar General, whatever it is. And they all have specific, requirements in terms of traffic. So I think that if you can find a piece of land that has a lot of traffic and some huge draws, then yeah, there's a high likelihood that can be developed into something that can take advantage of those traffic counts.
Oh, that's fascinating. Okay. I'm on it. I'm getting to work. I'm going to research this in my own neighborhood and figure this out. No, it's fascinating. Is there a preference for you, or is this really market specific? It seems like I'm trying to differentiate. Is it multi-tenant is your favorite, or is it the fast food style? Is there a favorite for you, or is there a preference, or like it's really market dependent?
That's like asking me, which kid is my favorite, right? I can't give you. There's no real answer to it. I like them all for
That
different
changes every
reasons.
day in my house. I can
I
answer that
like them.
question every day. It's different.
That's funny. But yeah, I mean, I like multi-tenant because it's got a lot of moving parts and it's got, opportunity for, like forced appreciation, as people call it. And it's fascinating to me. I mean, it's a lot of work. There's a lot of underwriting that goes into it. When I'm selling a shopping center, there's a lot of moving parts, getting estoppel certificates, for example, from each of the tenants. When I'm dealing with a single tenant net lease property, I almost like have a sigh of relief, to be frank with you, because to me, it's so simple, right? It's one tenant, it's one lease, it's very black and white, very vanilla. So I like them for different reasons. And for me, it's fun because it keeps it interesting because they as much as they're both commercial, net lease properties, they are very different.
If somebody new is coming to this space, what's the biggest mistakes they're making as an investor?
As an investor, okay, thanks for clarifying. I think that well, there's a few. One of them is just like deal fatigue or deal paralysis. Looking at 1,000 deals and never investing. I mean, I have friends that are still looking for a deal. And they probably would have been better off buying a deal that wasn't the home run, grand slam, whatever it is that they're looking for. This like panacea of amazingness, but it was a deal that was a double or a triple or whatever it is. You know what I'm saying? And then that'd be a learning deal, and they'd still be making money and building up equity and getting experience and all those things. So I think that is definitely a mistake. And then the other mistake is I've talked to a lot of guys who like they want to do it themselves. They want to figure it out themselves. They want to buy it themselves. They don't want a mentor. They don't want a broker. They just want to rough it. And like to me, that makes that makes sense. Like not at all, like zero sense, right? Why would you want to like figure it out the hard way? Why would you want to make life more difficult? There's so many great people out there. There's so many resources and courses and books and brokers and everything. So I think that that's a mistake that people do. They try to do it themselves. The best thing to do is get your eyes on as many deals as possible and have, a trusted inner circle that you can show that deal to. Like don't be afraid to show the deal to somebody that's going to say no. Like that is exactly what you want. I'm looking at a deal right now that I was excited about. And I brought it to someone who was a potential investor, and he's like, "Yeah, Dan, I'm just not that excited." And I said to him, "If you're not excited in this about this deal, I'm not doing it. You know why? Because he knows more than I do, and I wanna leverage his brain and leverage his experience. I think that's so important."
Yeah, what's the opposite end of the spectrum of folks that want to rough it? Because I think that's where I would slot myself in. Whatever the opposite is that you would call somebody, I want as much help as I can possibly find to do this work. I want to learn from other people's, hate to say failures, but other people's learning lessons. Give me all that. We want all of that here so people can be successful right out the gate. There's no reason to repeat the same potential mistakes that others have already made.
Yeah, I mean, it's just like what I was saying before, is that find someone or ideally a group of people who is successful at this and tell them, hey, listen, I want to be part of what you're doing. And if it's like a passive investment, where there's no boots on the ground, then tell them, hey, listen, next time you have something that looks good, let me know. I want to invest in it. And that way, you're partnering up with people that already have done this, and you're tagging along. I mean, it hit me. I was out west on a hike, and I was like it was bothering me. I was like, I need to find something to invest in. Like, but what do I want to invest in? Like, I've done all kinds of different things, and none of the things I've done in the past is what I want to do in the future for my investment side of things. And then it hit me, and it's like, Dan, you work with like the smartest, most successful, most amazing brokers and investors. Why wouldn't you just like go to them and invest in the things that they invest in? So that's what I did. And that's exactly what I was referring to a minute ago. I went to one of them and I said, hey, here's this deal. Like, I think I want to do it. What do you think? And he wasn't excited about it. I immediately checked it off my list. because again, like I want to leverage people who are smarter than me. That's how you do it, because you, Brandon, you can make your life easy by leveraging someone who had a difficult time figuring out how to get to exactly where they are. And by the way, that's where you want to be.
And the biggest thing that we found in that is, man, folks that have gone through that experience, they're also dying to help. So never ever be intimidated.
Yes.
Ask. They want to help, and they want it because you're adding value to them as well by showing them some of these. There's immediate value on both sides of that equation, and they're dying to help. Are you finding that as well?
Yeah. And guess what? They didn't get there. I can guarantee you those people did not get there on their own. Okay.
Mm-hmm.
If they tried to get there on their own, they wouldn't be where they are today. So they know what it's like to be in our situation. So yeah, a lot of people are very eager to help because, they look back and they're like, man, like, how do I say this? I get to be that person when I needed somebody. Now I'm that person, right? Like I look at it and it's like I've got a junior broker, and I'm so thankful because, I get to be that person that I had when I was new in the business, right?
Mm-hmm.
So same thing here. When you come to them, you're giving them the opportunity to be that person that they went to when they were new.
Yeah, 100%. It sharpens
And that's,
you.
I don't think that's common in many fields. I think that's a unique to real estate in my experience.
Yeah, I would echo that. I've been across a lot of different fields and industries. This is the most mentor laden, helpful place that I've been in from an industry perspective. No question about it. It absolutely is, because it feels like it is a space that's figured out, right? And when someone's figured out, they feel very good about that, and they're dying to help others kind of do the same thing. I'm going to pivot you a little bit. Talk to me about the CRE Pro course.
Okay, right on the same lines. Not even much of a pivot. So
small pivot.
A few years back, a small pivot, not like a full 180, but a few years back, I had just came to this revelation because I had a lot of people reaching out. So I was on these calls 2-3 times a week with people who were new to the industry and they wanted to ask questions. And I loved, getting to know them and talking to them. And it's funny, one of them, I just was interacting with him on LinkedIn, and he just bought his like second or third RV park. So it's like cool to see, someone come and, be successful. And after, talking to them when they just started out. So I was doing this and it was cool. It's not very efficient, right? I had to have people schedule time, and then I talked to them one-on-one. And I had a friend of mine who was in a mastermind, right? A group of people, 18 people, who were all in commercial real estate, all had different specialties. And we met once a month and talked and shared knowledge and had speakers and, worked to do deals together. So him and I were talking, and he said, I told him about what was going on. And he said, it's funny because I have the same thing. People are calling me a couple times a week, and I'm, giving them best advice as I can. So we had this idea that we would build a course, a training course to teach people how to become top commercial real estate brokers. Very elusive industry, very lucrative industry. Not a lot of training in this industry, right? It is definitely a sink or swim. Figure it out your own as for yourself, as you mentioned. So my partner flew in from Texas, and we had spent about 4 months putting together the course material. He flew in from Texas, and we rented out a recording studio for like 4 days, or a TV studio, production studio, excuse me. And we put together this course, 28 modules, and it goes through everything from databasing to cold calling. It gives you the scripts, shows you how to target tenants, shows you how to handle objections. There's a lot of role play back and forth, teaches you about 1031 exchange, all the different terms, and nomenclature within the commercial real estate agency, within the commercial real estate industry. Talks to you about the different choices being an investment sales broker versus a leasing broker. We released this course, and people loved it. I mean, it was awesome. We had, my junior broker, who I referenced before, I met him because he had gone to our LinkedIn Live sessions about commercial real estate, and he had gone through the course, and then he reached out to me. We had a mentorship program going on at one point, so I mentored him a little bit. And then he said, "Listen, man, can I come, work at your brokerage?" And I said, "Let's do it." So it was really cool. I mean, a lot of people benefited from it and were able to get into the industry and become successful because of the course. Our website is CRE, like commercial real estate, procourse.com. That's CREprocourse.com. And yeah, I mean, it's been an awesome experience. I was just on the phone with my partner this morning, and we're discussing some additional training material that we want to put together in the future, and something that I'm happy to have been part of.
Yeah, that's awesome. I mean, as you described that, like that's the playbook, front to back. If you want to learn, here it is, all of it. You laid it all out there, Phil. That's amazing.
Yep.
We're gonna have to link that in the show
Yep.
notes so people can head over there. Dan, this has been awesome. I think we could talk about. I got 100 more questions about triple net, but I'll save you and the rest of the listeners. Maybe that's volume 2. But where can people find you? Where are you on the interwebs that people can track you down, learn more, connect with you? Where should we send folks?
Yeah. So first of all, if anybody wants to talk shop, talk real estate, if you want a property evaluation or you're interested in selling property, you just want to, have a nice conversation about real estate, you can give me a call on my direct line. It's 248-943-2838. Again, 248-943-2838. You can find me on LinkedIn. My first name is Dan, last name Lewkowicz, Lewkowicz. I welcome, people to reach out. I always love talking to people in the industry. If there's anything I can do to add value, definitely let me know. And then obviously on our website, CRE Pro Course, you can learn more about myself and what we do, as a company. And I would love to interact with people and build some great relationships.
No, that's awesome, Dan. Thank you so much for taking the time to come on and answer some questions and let folks know about the triple net space. Thank you. I really appreciate it. And thank you all for listening. Until next time, bye-bye.